Hey everyone, welcome back. Now it's the last month of the year, the time when you should be preserving your profits. So you'll notice that on Monday I didn't do the weekly strategy video for a couple of reasons. I had a bit of a migraine that resulted from me hurting my eye the previous day or so. I was walking my dog in the park, and over here I think that the councils have not been doing cutting of the trees and stuff and everything, and I managed to walk into a branch, which was just brilliant, and it whacked me right across my face. And then I thought, oh, it was fine, you know, it's no big deal. But then unfortunately, come Monday when I was supposed to be doing the weekly strategy video, my eye was just like really red and it was just watery, and then I got a really horrible migraine to go along with it. Luckily, it turned out it's nothing too bad. But as a result, obviously, I didn't feel like staring at really bright lights. Sorry about that. But seeing how it is the last month of the year, let's talk about creating a weekly trading plan. I have traders coming to me who say things like, oh, but Dee, I only trade intraday. You know, I don't need a weekly plan. But let me tell you something. The best intraday traders always know where the price is on the larger time frames. Why? Because if you never go higher than like a 1 hour chart for your plan of action, you will never get a real context in which your setups are playing out. Ultimately, that leads to a lack of a systematic approach. Any lack of a systematic approach ultimately leads to difficulties in understanding exactly what happened and how it all looked on all sorts of various time frames. Therefore, if you had some successful trades, you're not going to be able to replicate them going forward with ease. You're going to forever wonder why that worked out that time, but then it didn't work this time. But with the creation of a weekly plan, when you have that large time frame context, as well as a smaller time frame context, those sort of questions of whys and hows basically disappear. Of course, I'm talking about proper way to trade, running your trading as a business and not some kind of wild man cowboy sort of trigger happy, whoa, it's moving, click, I'm in, oops, stopped out, click, oh, I'm in again, oh no, stopped out again, ah, fuck it. So not that kind of trading, right? We're talking about having a preset daily and weekly budgets for how much can you lose, how much can you afford for that particular period. Working within the constraints of rules and, well thought out trades with reasons for and against the trading idea. In that respect, your weekly plan should start on larger time frames and you should work downwards. So I'm talking about that multi-time frame analysis. Only then can you do your intraday market prep and then see how that relates to the weekly narrative. Now, whether you're going to use supply and demand, resistance support, Bollinger Bands, Donchian channels, 200 daily moving averages, large time frame profile TPOs, whatever you're using, that's purely down to you and your own individual style. Because each trader, is a mishmash of techniques that we've picked up along the way. And those of us who are quite analytical and systematic by nature, we would have tested most of them and then worked out which ones we connected to and which ones are about as useful as alcohol-free champagne. Before we go on, if you're not subscribed yet and you don't want to miss my future uploads, now is a good time to click that subscribe button if you're not already subscribed. And if you are subscribed, thank you so much for liking and subscribing. I really, really appreciate it. I also want to say thank you for such huge, overwhelming support that I received while my senior dog was sick. I'm truly, truly grateful to have such a wonderful community of animal lovers. All of your messages, emails, Twitter replies, they've really, really helped me. So I want you to know how much it means to me. Enough of the mushy stuff. Let's get to business. I'm gonna be a small tiny D here in the corner so that you can see like the entire chart without my mug getting in the way too much. Anyways, I usually start my weekly trading plan looking at the monthly chart, and then I work downwards. When it comes to some highly liquid instruments like crude oil, gold, like commodities, forex, anything like that, equity indices, I trade intraday exclusively. My own trades last anywhere between about 30 minutes up to about 2 to 3 hours. Whatever you're using to do your analysis, you should always note down only the levels of your chosen indicators, combination and or price action patterns that are located directly on that particular time frame. Don't mix up time frames. Reason why: you're trying to collate different information from different time frames, not to fish for the same information. You're meant to stay completely objective and factual in your analysis, not imagining what will be, simply seeing what already is. Huge difference, okay? The way I do it, I do the same type of analysis that you always see on a Monday, and I've been doing that for my gold members or for any students on the program currently, since even before I was on YouTube, to be honest, because I always had a small community of people who wanted to know how I, get to my trading ideas. I use supply and demand, Q points, developing and existing price action, as well as market profile for orientation. And to clarify, because someone just recently posted a comment on Blahtech supply-demand instructional video on how they don't believe in supply and demand. Well, buddy, it's not a matter of belief. The levels that you're seeing here, like for example, this massive supply here and this demand here, they're levels where previous large institutional inventory was located. So it's a fact. It's not like a belief. So whether you believe it or not, that kind of large institutional inventory left its humongous mark on the price already, which is why when the price of gold tested it on the monthly chart, tested this initial move away, we got another move away, a much bigger one. But however you choose to interpret that information through candlestick charts or through volume or any other kind of half-sane, not psychic way, is really down to you. The difference is how you will take advantage of these previous inventory levels once the price returns there. And with any liquid product, prices tend to return to these levels for one simple reason: because institutions need large liquidity that have enough units available at that particular price for purchase or to sell their existing positions. So it's not a matter of belief. It's a matter of market makers doing their job to provide their clients with liquidity. I've worked alongside traders whose only job was to be the market maker, to give their clients a good enough bid and ask price for the amount of units that they require, and then to make some commission for themselves in the process. That's a very different job from the speculative trader who designs strategies with an edge, generating alpha. Very different. Once you've marked your levels of interest using whatever method you're using, I suggest writing it out. So for me, it would be like you have this area here, and then you have another little demand here that was reactive. Then further down, you have this overlapping offspring demand, as I like to call them. So all of these levels would be my levels of interest. And I say start writing it out. Why? Because in the heat of the moment, especially with intraday trading, you're going to forget what the hell was this line here and what context it represents. But if you have a ready-made document, print it out so that you can reference right before you're about to initiate a trade, that gives you a lot more accountability. And it also provides you with the potential to realize that maybe you might be wrong as well. If I put in my trading plan, trend up, strong, and then if I elaborate why I think the trend is strong, price made a confident higher high, pierced a top Bollinger Band on 2 large time frames, or if you use something like Keltner or Donchian channels, price exited a channel on the daily. All of this is telling you the same thing. It doesn't matter how you look at it or what you use to look at it. It's telling you that there's a widening of the ranges that we've seen so far. But in the heat of intraday trading, I get people who see one bear candle on a 5-minute chart, and then they're immediately entering the opposite direction to the large time frames. I'm like, whoa, hold up. And then they go, oh, it doesn't work, this is shit, this is market's against me. Well, no, okay, that definitely doesn't work. Just jumping in randomly and hoping for the best. That's never worked for anyone. If you want to see what my trading plan usually looks like, it's quite simplistic. First thing that I personally look at is where the current price is in relation to the previous swing. So for example, here it says monthly Q high with supply higher up into it. So what I'm saying here is I'm just looking at the position of the current price in the entire swing. Is it at the previous swing extremes? Is it at the middle? Is it already rejecting a swing extreme? And that's the second thing that I look at. Is there an existing price action pattern that might signal a reversal? Then if I show you this daily run through of factual data, it says phase 3 on D1. I like to note down whether the price is in one of my 4 phases. And this has nothing to do with the trend, because the 4 basic market structures exist in both downtrends and uptrends. When there is a trend, it's generally rather obvious, but bizarrely, trending markets can be some of the toughest markets to catch a trade once the trend has already started and it's just shooting up or down. This is the gist of my trading plan. It's relatively simplistic. So, your weekly plan doesn't have to be anything spectacular. It is a simple, objective and factual document of what's on the chart already. And if you're not writing all of this down and you're attempting to remember all of it, this is all the stuff you're going to have to remember. There's a monthly Q high and a supply higher into it. There's a Dow Jones weekly chart, weekly Q high higher up near the supply from the monthly. Phase 3 on daily, but blah, blah, blah. Consolidation not valid. Profiles, supply nearby monthly Q high. It's so much information to remember, right? Especially like doing it on the fly, Trying to remember several pieces of information per each time frame is difficult, even when there's zero pressure on you. But, throw in some live trading in the mix, or even trying to pass a prop trading challenge to get a funded account from somewhere like Top Step or somewhere else, and you've got a disaster waiting to happen. And then you blow it in 3.5 seconds. That will create unnecessary psychological traumas. So I really don't get why some people are so resistant to writing a weekly plan. It does take some effort and time and some research to gather all these pieces of information. But I guarantee you that any trader who has had consistent success will start their week and even their day writing a comprehensive plan of action. You cannot really judge yourself by every individual trade outcome. Instead, you really need to judge yourself by the process that you took. And if your process sucks, sooner or later it will come back to bite you. And since we're talking about the process, I also want to point out that, just by writing a plan, that obviously doesn't mean automatically you'll be successful either. If your current process uses flawed techniques that are not consistent enough, the weekly plan will uncover these faults. Therefore, you will have a benchmark so that you can modify things that are not working, keep things that are working, test, and then change stuff around as required until you get to a point where the majority of your weekly plans are working. Now, notice when I say working, they are working, this doesn't mean profitable. Initially, it's very likely that your weekly plans might be directionally correct, but maybe you didn't manage to actually get into any good trades that week. And that's fine. At least you got the direction right. Any good trading idea has 2 components: trade direction and trade location. How you initiate a trade is down to what sort of entry techniques you're using. Just by having an area or a key level of interest, that's not really good enough. Entry techniques, they're plentiful, right? It's the reason why I have the pro development program. There's 1,000 ways to skin a cat. One person might be going into a trade based on value acceptance, and then another person might be initiating the same trade, but not based on value acceptance. Instead, they noticed an initial balanced extension. Both traders correct, both traders came up with the same direction, both traders seeing similar things, but their entry techniques, entry prices, stop losses, they will be at slightly different areas. But the very first step to systematic trading must involve a solid process that will allow you to expose flaws in your approach. And making mistakes is a crucial step in any skill development. That's why every trader who wants to do this as an additional serious, consistent income, rather than treating it like a trip to a casino, you must start with a systematic process of hunting for flaws by writing this weekly trading plan. And if you notice the same mistakes happening over and over, then you've got a problem that indicates that some stuff needs work. So start solving this problem by sitting down a couple of hours on a Sunday and writing down a plan, and then reviewing how you've done at the end of the week in the framework of that plan. You know, it's called a post-mortem analysis, and we do it all the time for our gold members. In fact, for a lot of them, the first few weeks, it's all about seeing something on the chart. Getting in a trade, not getting in a trade is beside the point when you're first starting this process. And then at the end of the day, at the end of the session, I also want to see their post-mortem analysis. Some people call it the daily report card, other people call it the aftermath of events. You know, you can call it whatever you want, but you have those two processes that work together to push your skills forward. You know, if you want this side income or, you know, a main income from day trading, you need to be more systematic. Trading well is a fine line between different components of the risk model you're using, honing the trading tools and the indicators you're using, making sure that not too many of them are showing you the same thing. Like, for example, if you're using Bollinger Bands, you probably shouldn't use Keltner channels as well, because they're way too similar in what they're showing you, and there's no real benefit to having both on the chart. And then finally, it all comes down to your own observational skills. You shouldn't see the weekly plan creation as something to be feared or something that's annoying to do every single week. You should start to see your weekly plan as the first step towards your new future. To visualize yourself becoming this disciplined, skillful trader, running your day trading business like a business. Some people talk about law of attraction, and then most of the people that I've spoken to, they think it's about imagining extra income and resources in their life, and those resources just falling into their hands out of nowhere. And to me, that's fucking hilarious. Visualizing a different future for yourself isn't about some abstract law of the universe to magic up more money with no new skills. It's about imagining how you would like things to be and then working to change your life to be closer to that image. And with day trading, that path needs to start with the weekly plan creation. A weekly plan that will enable you to systematically track the changes happening to your own skills. I hope you found the video useful. That is all that I have for you today. Thank you for watching, and I will see you next time.